Hello and welcome to episode 190 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, welcome back. How are you doing? You looking good?
I'm good, Andy. Busy as ever. I managed to lock myself out of a house today with no shoes, which was interesting. I managed to overcome the situation.
That sounds like the premise of some sort of Carry On movie.
Look, I won't go into too much detail, but do you remember years ago I house sat for somebody, and technology seemed to ruin things by the person being in Thailand and seeing me alter their thermostat because it was the winter, and they were getting alerted in Thailand and thought something was wrong and would turn their boiler on and off. It was kind of technology. It was like that. So technology ended up meaning that I was round somebody's house. I was house sitting very, very sort of briefly. I was in the house. I didn't have my shoes on, and then they messaged me to say that Amazon had delivered a parcel to the house, but I was in it. And I was like, that's strange. They said, it appears that they've left it in our waste area. They've got like a little, one of these little wooden boxes outside their house where they put their wheelie bins.
Yeah.
And so I walked out the house to go and have a look because the person who was in, again, the other side of the world technology had informed them of this. I walked out the house with only my socks on, and I didn't realise, but the door blew shut behind me, and the keys, and I was stuck outside with no shoes in the rain. So there you go. So I blame technology, not my own foolishness. But the weird thing was, as I walked out the door, I thought, there's no wind, the door won't shut. I'd even calculated the odds of that happening, completely dismissed it. So that was my day anyway. So
the only one question I've got on that, there, I mean, believe me, there are lots, is why you decided to proceed outside of the house without shoes on. It's fair enough. I walk outside of the house without shoes on. But the fact that it was raining, that kind of, that one doesn't compute.
I'd only decided it was just round the side of the house. I didn't really need to. I thought I could tiptoe quickly round, and in the end, I failed. And I won't go into too many details, but it involved me getting a builder who was working across the road to help me basically break back into the house, and having to convince him that I wasn't a burglar, which pretty much boiled down to the fact I said to him, well, I haven't got shoes on my feet, and and that confused look seemed to be enough to convince him I was responsible enough and obviously the right person to be let back into the house I was trying to enter. But anyway, that was me, Andy. So how was your week? Let's not dwell on my stupidity.
My week was okay. I was going to say, but hearing you say about tiptoeing out of the house and thinking you could probably make a dash for it and make it back. And did I ever tell you the time that I tried to outrun the speed of light?
No, Andy.
Okay, so what happened is one evening, and I don't drink. Okay, so this
just drugs by the sound of it. Yeah.
Yeah, this is not a story that follows drink. I decided that I needed to turn the light off. And I got halfway up the stairs and forgot to turn the light off. And it was like a lamp on the other side of the room. And I thought, and my phone was upstairs. I didn't have a torch on me. And so for some reason in my head, I walked over to the lamp and thought to myself, right, I'll quickly turn this off and I'll get to the other side of the room. And it was pitch black in the middle of winter. I turned the light off and started running, thinking, I'll make it to the other end of the room while it's still light. And I got halfway across the room. It was completely pitch black. And I just realised at that point, what am I doing? I'm trying to outrun this light turning off. And obviously I got stuck in the middle of the room and had to crawl to the edge of the room to find the wall to go back upstairs. Anyway, weird.
It sounds like an episode of The Crystal Maze.
Yeah, that probably won't make the pod. Right.
Well, no, I think it should. And Mark, who often fast forwards our intro, would have missed that. What we got on this week's podcast, Andy, there's quite a bit, actually. I've kind of pretty much sandwiched two investment pieces into one. So I will cover that at pretty much the speed of light. There's also a piece on a shocking car insurance. What's the word, I suppose? It's
revelation.
Revelation's a good one. It's not a scam, it's a revelation, because it's something that could inadvertently put up your car insurance without you realising, just by doing some research online. It was quite a bizarre story. And the last piece I'm going to do, which might be a bit of a merger again, it relates to some of the stuff I've been doing this week for journalists in national newspapers. people who listen to the podcast will know that I often get asked my opinion on things. They might not want to ask my opinion anymore if they listen to this podcast, realising my inability to put shoes on. But I want to talk about some of that. And unfortunately, it may only be August, but I'm being asked about Christmas. So I will touch upon one of the bits I did. And forgive me, it has got a slight Christmas theme, but so is the world of money and personal finance papers. So, before we do that, I just want to mention that Emily emailed in this week. And do you remember I spoke, I don't know if it was on the last podcast or the podcast before, where I mentioned about women and finance?
Yeah, you asked to hear from our female listeners to see if we had too much of a sort of male edge and if we were making this podcast for all.
Yeah, for all. And what happened is Emily wrote in, and it's a very good email, and pointed out that I think largely that the podcast is for all, but obviously highlights some of the issues women have in finance. And she did mention another podcast which I don't mind promoting, by Savvy Woman. Now, Savvy Woman is savvywoman.co.uk, and that's done by Sarah Penals, I think you say her surname, Penals, and she's a journalist you see on programs like Watchdog or things like that every now and then. So she has a bit of a profile, but hers is Savvy Woman and it's based around women and finance. So have a listen to that if you're into podcasts. I've not personally listened to it, but there we go. So that's a great bit of feedback. The other thing that we had a review, I was looking for the reviews. Now, we haven't had a review in the last week from anybody on this podcast, which is slightly disappointing. Now, I'm away for part of next week. I'm actually having a well-earned break. I'm going away with the family. So it'd be wonderful by the time I'm back that we have a new 5-star review. In fact, more than one. So if you haven't reviewed the podcast lately or ever, then please do so. You can do that via your podcast app, and it helps us go up the charts. But we may not have had a review on this podcast, but somebody actually reviewed the One Giant Leap podcast last week, which was unexpected because I haven't actually done a show on that podcast for 18 months. So I'll just briefly read it out, because for people who've not listened to the One Giant Leap series, it was a series we did relating to people taking a leap of faith in their own ability to do something, normally a side hustle, something that was maybe something they wanted to do. There were stories of people helping charities, launching businesses. You were interviewed on it, in fact, Andy, for your epic writing and chart-topping success with Amazon. And I keep promising I will do a second series, which I'll try to at some point if I get time. So this is the review. Brilliant, it says, by Kevin Kilty, I think it is. Damien has another great podcast here, full of why didn't I think of that moments. I've just finished my second listen through to the series and can't rate it highly enough. Look forward to season 2, in brackets nudge. I will keep the Scarlet episode on my phone to bring me back to those days when you start to lose faith in humanity. If you somehow found this without listening to the Money to the Masses podcast, make sure you give this a listen. Now, the Scarlet episode was the lady who started a charity that helped clothe homeless people. Right, there's the admin done, Andy. Let's get on to the money stuff. So
yeah,
I'm gonna start with the investment piece, because that's the slightly longer piece. But
you're going to give us 2 for 1 here, aren't you?
2 for 1, yeah. What I'm going to cover is stress testing and multi-asset funds. Now, these have been inspired by some research pieces I've done for 80/20 investors. One this week and one that will be out next week. So if you want to get a full lowdown on them, I just touch upon bits in here. But if you want to get the full lowdown, then you can take a free trial, as the teaser says on this podcast. What I did this week, I updated the stress test tool that I created. Now, when you have a portfolio, typically you might want to know how it performs in an environment where markets are under stress. So there's a tech crisis or something like happened in the spring of this year when volatility jumped, and everybody thought the bond market was going to collapse, and it led to the equity markets to tumble, a correction. Now, big investment institutions do stress test their portfolio. So what they will do, they will run scenarios and say, well, in that scenario, how did my portfolio perform? Now, as investors, you can't do that. There just isn't the tools out there available to do it. So what I did for 80/20 investor members, I created a tool which tests the any fund out there, so you can recreate your own portfolio in it, and it shows how it performed in a series of events, and also looks at certain key fund metrics that show how much return a manager is getting for it, the return they're taking. Now, I've updated it this week, and to let you in on the scenarios that I test, one of them is China. So if there was a sell-off as a result of China doing something, where it could be them devaluing their currency, which is something that is kind of going on slowly in the background now, but we had it happen way back in 2015, which caused the previous sell-off in equity markets prior to the one at the start of this year. We've also got a banking crisis, so from time to time we seem to have worries around a banking crisis, and again, with what's been going on in Turkey recently, there's been people raising concerns whether there could be some issues with European banking because of the how entwined Turkey's economy is with other economies in Europe, and it's largely down to the amount of debt that Turkey has. Also, what happened in the spring of this year, so the bond spike and the volatility spike we saw, which basically caused mayhem in bond markets and equity markets, that's another scenario I test. And a tech sell-off, because we actually had one, a very brief but very strong one this year, and so I look at how all the funds perform in those scenarios and give them a score, like to stress test them, so you can see how funds perform against their peers. It's incredibly useful, people enjoy it, and I use it sometimes when I'm looking at funds to say, look, where are we now? And at the moment we're back near all-time highs, and the market currently looks very much like it did in the spring, just before we had a sell-off. There are lots of things that are aligning. We're near all-time highs, volatility's gone back down again, tech stocks are pushing the market ever higher, in fact they're at new all-time highs. So for 80/20 investor members, they can have a look at it. But for this podcast, I want to give people a little bit of a teaser which they can go away with and look at. You remember I said about a tech sell-off. Now, with tech stocks being probably the most overextended trade since the dot-com era, which was again a tech stock driven rally, it's probably the most popular trade at the moment. So a reversal is likely, because if everybody's in the trade, then they all rush for the exit at the same time. We could get the trade unwind. Now, between the 20th of March this year and the 2nd of April this year, the key tech stock indexes, so the Nasdaq 100 over in America, fell by 5 to 6% in a matter of days. That's a huge swing, and all funds that had a exposure to tech in some form or another would have obviously underperformed. And so if you look at how a fund in your portfolio, if you go and look at the charts that you will see on your platform, if you look how it performed during that period versus its benchmark or its peers within the same sector, then you can see how it might perform if we suddenly do get a big tech sell-off, which some people think is a likely thing to happen at some point. That is how you stress test and scenario test your portfolio. So those two key dates, the 20th of March 2018 and the 2nd of April 2018, look to see how funds performed during that period, because that will be a very good stress test for a technology sell-off. Of course, it's difficult to do that widely with all the funds out there. That's why I built the tool. So what you'd have to do is go through one by one, but it's realistic. You can obviously do it if you want to. So moving on from stress testing, so there's how you could stress test for a tech sell-off. Multi-asset funds. Now, I was asked about multi-asset funds, and I don't know if people know what they are, but most funds out there invest either in one asset equities, or they might invest in bonds, and they sit in sectors with appropriate names like UK all companies or global equities and stuff like that. So they only focus on one asset. Then other funds, they're called normally managed funds, and they inhabit the sectors with the word mixed at the front. If you look at them, you'll find them. There's 3 of them, and the flexible investment sector. But they're managed funds that you will see in your pension or your ISAs that are a merger. They're a mix of bonds and equities normally, and cash. Now, nearly every fund has a small cash holding of around 5%. That's for liquidity purposes, so it's not really a decision about asset allocation. So what happened is that we had managed funds. They'd been around for years, but then where we try to diversify by investing in different types of assets, the marketing people out there for these fund houses went, do you know what we need to launch? We need to launch a multi-asset fund, and they market it as such. They give it a name, as multi-asset. They talk about it being multi-asset. So it's almost like a single fund solution. So it will invest in bonds, it will invest in equities. But the question is, what else do they actually invest in, multi-asset funds? And I did a whole piece of research trying to work that out, because there are lots of funds that have the word multi-asset in their name, but there are also far more that don't have it in their name that are actually multi-asset funds. And funnily enough, there are multi-asset funds that are called that aren't really, in my view, multi-asset funds at all. So I went through and analysed 350 of these things that I worked out that existed, because they don't have a sector. You have to look across a number of sectors. And what they do, they normally buy bonds, equities, they have cash by almost default, they have property, they have commodities, and they have alternative assets. So they tend to have some sort of strategy that will try and work in any market condition. Now, if you look for a multi-asset fund and you find one, and 80/20 investor members, there's a piece coming out next week where I actually identify all the funds out there that are multi-asset, not the ones that just bond and equity mix with a bit of cash. That's not multi-asset really, that's just dual asset, the ones that are trying to do something different. And I actually find them all, which took me a day to do, and tell you what they actually invest in, so you can have a look. But just to give you a steer, most multi-asset funds, when you look at it, are just tinkering around the edges. It's really a marketing exercise. There's no conviction in there. What they tend to do is they tend to invest around half their money in equities, around 30% in bonds, and around 7% in cash. That's an average for any fund, to be honest, even if it's not multi-asset. And they put 13%, only 13% in things like property, commodities, or alternatives. So that's about 13% tops that you're going to get of your portfolio in something that is really an alternative asset to bonds and equities, which isn't that exciting if you think about it. So most multi-asset funds just play around the edges. Now, with those numbers I've given you, if you have a multi-asset fund, go and look at the fund fact sheet, see if those numbers stack up against what you've got. Because what you really want is a fund that does something with a bit of conviction, doesn't follow those broad trends of really being just a mix of bonds and equities and taking around 10 to 13% of their money and just put it in commodities and properties and alternative assets, just so they can say they're multi-asset, tick that box and keep the marketing people happy. When you look at it, they don't actually add much value in terms of returns either. They tend to underperform those funds that just stick to being bonds and equities. That is not to say that having different types of asset in your portfolio is a bad thing. It's just saying if you let somebody as a fund manager do it, they tend to just do it in a way that doesn't really have any conviction and just ticks a box. You're better off picking them yourself and picking a broader portfolio. So the message is there isn't really a single fund solution out there that you could buy that is really completely mixed asset. If you're wanting something like that, you're having to go more towards the robo advice world, so where they actually just give you almost one fund but a portfolio where it's really discretionary managed and they do a little bit more with what they're doing and they buy ETFs. That is probably the closest thing you're going to have to something that is going to be, you just leave it. Whereas fund managers, because the fund isn't bespoke to the person buying it, they don't know really who is buying it. You're just buying into a fund that's run by a particular mandate. It's not personalised in any way. Whereas at least with a robo-advice firm, you will get a portfolio or a range of portfolios which you can choose from, which is a little bit more moving down towards the area of being a bit more bespoke. It's not true bespoke, but it's at least a bit discretionary. So for 80/20 investor members, I go through in great detail about how globally diversified multi-asset funds, what to look for, what to avoid. But for podcast listeners, the big takeaway is don't believe the hype around multi-asset funds. They don't really deliver on much of the promise the marketing material says. They tend to be very low conviction. And if you want a multi-asset fund that is really doing something different, you need to find one that is not only investing 10 to 13% of its funds in anything other than bonds and equities. You'd want something that has a little bit more conviction. But of course, that means it's got a greater chance of outperforming, but also underperforming its peers. But that is not necessarily a bad thing, because multi-asset funds should really be doing something. They should be trying to do something different for a reason. Now, there'll be people listening to the podcast going, oh, hold on, Damien, but it's not all about the upside, because I thought the idea of multi-asset funds was to see how they would do in the downside. They protect you because they're in different assets. Now, the reason why this piece links quite nicely to the stress test area that I just talked about is that if you go now and take some of those multi-asset funds and you test how they performed in key market conditions, so the tech period I said, or go back to the spring sell-off, look at how they performed during that period. It's just a simple case of looking from the peak of the market to the bottom of the market and see how they fared against their peers. Unfortunately, lots of the multi-asset funds don't really come away with a glowing school report. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so we're going to talk about car insurance next, and there's a weird quirk that's come to light in the news this week. What have we got?
Right, this is quite unbelievable, really, but doesn't surprise me in another way. It almost relates to, or it reminds me of a story or practice that we spoke about in a previous podcast, whereby somebody called up to find out whether their home insurance covered them for a certain incident or eventuality, only to find that by making that call rather than checking their documents themselves, that had been marked on the database and it resulted in them having higher premiums in the long run. And that was because they were deemed a high risk. Now, there's another equivalent that is more surprising perhaps in car insurance, in fact any type of insurance, and it's when you use a price comparison website. Now, there was a lady that I think this was revealed by Money Saving Expert, which was interesting because they are basically linked to a price comparison website themselves. But a lady went on to compare her renewal quote. She got a renewal quote from Admiral Insurance. So she got it. She thought, do you know what? I'm going to go online and go to Compare the Market, was the company, and put in the details to see if this is a decent renewal premium. And then what I'll do is I'll just ring up and negotiate. Sensible, because you can often just negotiate with the person you already have your insurance with. In doing so, she had a speeding fine previously, but she couldn't remember exactly when the speeding fine was. So what she did, she thought, I can't remember when it was. I think it's 2013, 2014. It doesn't really matter. It's around that ballpark. I can't be bothered to look it up. Just say, it's probably, let's go with a date. She put a date in 2014. She got her comparison, looked at it, thought fine, went and spoke to her insurer, negotiated a cheaper deal, accepted her renewal, everything was okay. But then, a few weeks later, she was charged another, I think it was £47, so let's call it £50, by her insurer, and she didn't know why. It was taken from her account. So she called them up, and they said, yeah, basically what's happened is you disclosed when you were doing the price comparison online that you had a speeding fine in 2014, so we've updated our records to reflect that. Now, what's alarming about it is the lady said she did the comparison, and then when you get the results screen, she never clicked through to any of the results. She just saw the results, looked at it, went, okay, saw the table, I'm going to speak to my own insurer. The details that she had been put in had obviously been fired through to each insurer so they could provide a quote. But while all the big four price comparison sites do that, so when I say big four, that's Compare the Market, Money Supermarket, Confused.com, and Go Compare, while they all take the data and obviously pass it through to the insurers, what three of them do, so Money Supermarket, Confused.com, and Compare the Market, they allow the insurers to also use that data they provide to change your premiums mid-policy. So that's exactly what happened in this case. Now, Admiral took that lady's data, what she'd put in the price comparison, a guesstimate, roughly, just to get a steer, and they took it and went, well, she hasn't disclosed that to us, so they upped her premium and took her money. Now, they say they wrote to her and gave her 2 weeks to speak to them about what had been put in, to correct the details or whatever. The lady says she never got it. I mean, all these things are up for debate. So that's why they upped their premium. But what the issue and what the sort of moral of this story is it's important to not guesstimate when you do a price comparison. And now, I, for one, and probably like most people, would not necessarily think about that. I mean, when I do that, a lot of them actually allow you to save your details each year. And I know one does in particular, I'm not going to name check them, but because I use them, and they will save your details. So next year you go in and press a button, it just renews your quote, and it just adjusts the year for everything. So it allows for the fact you're a year further down the line, and that makes comparison easy. Also lazy, but easy. But if you put stuff in, don't guess at it. Make sure you go and find the right details, because you could find your premium being bumped up. But more seriously, which is what wasn't really pulled out much in the article, is that the insurers theoretically could use the data for reasons not to pay out on a claim, because they think it was non-disclosure. In this lady's case, they actually thought it was a new speeding incident she hadn't told them about. They didn't think it was just a change of date. They thought it was a new one. And so you could find, if you guesstimate, that something could happen that you might not, they might not pay out or refuse a claim or something like that. So it's just an FYI, don't guesstimate when you're doing price comparison. And perhaps the moral of the story is just don't speed in the first place.
Yeah, exactly. Well, great. That's good to know. And like I say, like you said there, the comparison sites aren't doing anything wrong necessarily. They're doing things. It's technology really trying to make things easier for everyone, and they link it off to all the insurance companies. So this isn't, a blame game as such. It's just make sure you are doing the right thing and making sure it's all accurate.
Yeah, and one thing to bear in mind is that you have to realise that insurers aren't here to make your life better. They don't really want to pay out your risk. So what they will do is any interaction, and this is something important to bear in mind, any interaction you have with an insurance company can have a potential implication for your premium. Now, you may remember another story I've told, and I'll just remind people who are new to the podcast, of somebody who had a minor knock to their car and paid for it to be repaired themselves. So when the car insurance company, when they came to renew, the insurance person said, have you had any accidents? They went, oh, no, I've not had any accidents. I did just knock my car and repair it, because they just had a sort of minor dent, because I think they'd reversed into something, and nothing major, just a bit of paintwork. But their premiums then all leapt, and that was again because they'd revealed to the insurer that they'd had a incident, very minor, that was a scratch on their car as a result of something, and so the insurer took that to mean that they were at a higher risk of a future incident that they would have to pay out on. So I'm not telling people you always be honest with insurers. That's the first and foremost and most important thing. But any interaction you have, bear in mind, it will almost certainly be recorded, but it could have an implication on your premiums.
Good. What have we got for our last piece?
Right, the last piece is the stuff I talk about in the week. So you might wonder, what does he talk about when the insurers ring him up? Or, not sorry, insurers. I've got insurers on the brain. When the journalists get in touch and want Damien's opinion. Now, one of them was on investing. You may have seen something called Spot the Dog. It's run by one of the investment companies, and they basically every year do a dog fund. The fund's in the doghouse because they've performed badly over a period of time. And they have a metric, and it's all these very PR friendly. The papers lap it up. I don't mean that in a pun, but they literally do. And so every year it's good PR for this investment company. I got asked my opinion. What do I think about it? Woodford was in there, actually. Neil Woodford, the man who apparently the fund manager people seem to or previously loved. He's in there this now. And obviously my pretty much one-liner is take it with a pinch of salt. It's a bit of a marketing ploy. All you really need to do is take away from the whole thing is you shouldn't buy and hold funds indefinitely. Every dog has its day, and therefore you should review your funds regularly, at least once a year, and move accordingly, make changes according to your risk and the market's the sort of backdrop. So don't buy and hold. That's the biggest dilemma. Now, the other thing I was asked about was Christmas. And I'm not going to dwell on it because it's a bit early for Christmas and I've not even been on holiday yet. And what I was asked is, how do you make Christmas cheaper? And by planning early, 20 weeks away at the point I was asked from Christmas, what do they need to do? And I obviously went through with the usual thing. Don't buy so many people presents. I don't mean that in a sort of Scrooge way, but cut the list down. Only buy for children in your family, agree that. But the point is that if you start, they want to know how much does the average family spend on Christmas. And apparently it's about £800 according to research I've seen. So that means you've got to start saving £40 a week if you're going to not go into debt. So that's something to bear in mind. Now, how do you start saving? Now, we talk about Save the Change, these accounts that are out there. Lloyd's have one. Lloyd's have one where every time you use your account, it rounds the amount you spent up to the nearest pound. So if you spend £2.60 on a sandwich, it will put 40p in your savings account. It's a very easy way to save, and I know you've done it, Andy.
Damien, I'm doing it. I've started doing it again now. I stopped it for a little while because quite frankly, I didn't want to see the money going into there. I needed it at the time, but I've started it again, and I can tell you, literally just in the last 1 month of doing it, I've completely forgot about it. I checked it just the other day. I've got £36.80 in there from 1 month's worth of transactions. Now, part of me says I'm obviously spending too much on things, but it's not really a lot. I spend everything on card. I think you're quite a fan of the cashless world these days. Use your card for everything as much as you can. And I've noticed that there's so much money going across into there without me even realising. It's such a good thing to do.
Yeah, and that Andy's just beautifully illustrated why those sorts of things are good. If your bank doesn't do that, then there is an app called Chip, so CHIP, which does the same thing. It links up with your bank account, and it uses an algorithm apparently to look at your balances and work out how much you can afford to sweep across into your savings account, and will do it for you. So I've not used it. I've known a lot of kind of money blogger types love it, and I'm sure it comes with a fairly decent kind of a review. So have a look at that. I was asked about savings account. That quite frankly, putting money in a savings account is probably not worth it, to be honest, because of the low savings rates, and some of them only pay savings annually. Now, if you want to get a little bit of money on your savings, then you need to go for a high interest current account. Again, TSB have one that pays 5%. Now, there are caveats that you have to put in £500 a month, but you can put it in and take it back out. You've ticked the box then, and they only pay interest on up to £1,500. So there are caveats. Have a look. But high interest current accounts, they pay monthly, and they're probably the only way you're going to get interest if you're going to start saving. But the other one is look out for account switching deals, and Marks and Spencer's do one where they pay £125 at the moment, a gift card, which you will get after a month of using the switching process, which should only take 7 days under the industry rules. That you can get a gift card, which you obviously could use to buy the turkey. So that's something to bear in mind. In terms of buying stuff, then I've always liked things like camel.co.uk. So that's the animal, camel.co.uk. I know Amazon are largely disliked for their sort of tax avoidance and everything like that, or should I say the lack of sort of level of tax they pay. But let's be honest, most people use them. Then that website, camel.co.uk, does price alerts. So it tracks the price of an item over time. So you can put a URL from Amazon in there, and you can see when it's going to be, whether it's a good deal, and it can even alert you. So you can buy stuff at the optimum price. Obviously, there's seasonality in some stuff. So in September, buying is the best time apparently to buy computers and mobile phones. October is good for cameras, and December is good for Nespresso coffee machines apparently. And in terms of discount days, Black Friday, Cyber Monday, apart from being crazy, they don't tend to offer great value if you base it upon what goes on in America on branded goods. They tend to be good value on non-branded items, if that makes sense. So what I'm thinking of is the high-level brands that people might want. They tend to be good on things. If you just want some form of telly, then you could get a cheap telly because it won't not necessarily be. I don't know what is a good brand of telly these days. I don't know.
I think a good brand of telly is someone like Samsung or Sony, and the sort of the lower end of tellies I would say would be someone like, I don't know, Hitachi or LG.
Yeah. So I think that particular piece was. I can't remember which paper it was. So they've got oodles of shopping tips from a man who, quite frankly, hates shopping. But there we go.
Good, I enjoyed that. Now, you mentioned at the start of the show that you're going on holiday soon. Are we having a break next week? Should we break it to the listeners now? What are they to expect over the next couple of weeks in terms of podcast?
Silence.
Okay.
Yeah, no, what we're going to do is there won't be one next week because I will be a period where I'm away, and I think it would just be too much to try and get one. But we'll be back with a vengeance the week after. As ever, and we'll have our it's quite an exciting time because we'll be heading into the last quarter of the year, and that's going to be, there's a lot going on at Money to the Masses behind the scenes and development work. I keep hinting at it, but it is there, and you will see the fruits of that by the end of the year. So yeah, we're going to have a week off, Andy. You enjoy yourself.
Good. Okay. So when the schools go back, we'll come back too, and we'll have lots and lots of exciting content for you. I'm excited. I'm looking forward to it. Do you know what I'm excited about most? And I know I'm thinking too far ahead now. We're still in the summer. We should be in the summer mode. I'm already thinking about the schools going back. I'm thinking about October half term, getting a little bit sort of autumny. Am I just a misery and wishing the summer away? I think I probably am.
You probably are, Andy, but I do have some of those sentiments. I don't mind the winter, but I don't particularly like the autumn, to be honest with you. The wind and the
really autumn's my favourite season.
No, the wind and the rain. I sleep in the loft, and the wind what keeps me awake. Anyway, I'm off for some sunshine. Let's focus on sunshine.
Focus on sunshine. If you want to get in touch with Damien, it might take a little while to respond while he recuperates and has a well-earned break, but do still send those questions and queries across to him at Money to the Masses with the number 2, or Damien at moneytothemasses.com is the email address. Please do, as we said at the start of the podcast, please do review the podcast. It really does help us out. Give Damien a treat when he returns back from holiday and checks his phone and he can see that he's got 10 new 5-star reviews. That would be amazing. So Damien, enjoy your holiday, and until next time.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.